Today, there are businesses like Titan, businesses like Asian Paints, which have fallen maybe 25 to 30% over last 6 to 8 months. And we have been hearing a lot of new age fund managers and many other fund managers also time and again saying that these are some of the best businesses. And whenever these businesses fall by say 25% and more, it is an opportunity to invest in these businesses. So today we see Asian Paints fallen from 3,500 to almost 25, 2,600. Bajaj Finance is also kind of fallen similarly 25%. And there are many such examples. So anybody, obviously most large investors would be holding some of these businesses already, like all fund managers hold. But is it a time to actually add more of these businesses, or if you are not owning these businesses, you are a first time investor, should one see this as an opportunity, or one you see this market giving a signal of something bigger coming towards these businesses, because despite fall, these businesses are still high in terms of price to earning multiple, which many fund managers have been saying doesn't matter at all. Price to earning multiple conveys nothing, right? So I want to understand, because we understand even Asian Paints today maybe P is above 80, Titan also above 80, and many other businesses P is above say 50, 60. And at the same time, there are many other growth businesses where P is around say 25 to say 35. So obviously those are some of the businesses which we find in real estate sector, some of the less owned sectors. But what are your views in this regards, from 3 year perspective? And just a disclaimer to everybody, we may be talking about few stocks. It is not to be construed as any kind of an advice. It is just a matter of understanding by taking an example. Over to you, Naveen.
Sure, Kamal. So, Kamal, for us as a running a fund, uh, loss of capital is just not because the stock price falls. Loss of capital is also because over the next 2 to 3 years, you might not generate any returns on the stock. What do I mean by this, right? So let's assume that a business is giving you an earnings of 100 rupees today. You're giving a multiple on it. Let's say you're giving an 80 multiple on it, as a result of which the stock price is at 80,000. Okay. Sorry, 8,000. Right. Now, over the next 3 years, this 100, if the business grows well, can compound at, let's say, 20% for simplicity's sake. So your 100, your earnings will go north of 160. So compounding will be slightly higher than 160. Let's just take for simplicity's sake 160. So 160, and your stock price need not have moved at all, right? Your multiple can still be 50. So you can say I have bought a great business which is growing at 20%, which would be among your top decile of companies in India, but you need not have made any money as a result of it. Right. So just because, I'm not saying you cannot earn money because you buy a high PE stock. End of the day, that has to be rationalized by also saying how well the management is reinvesting that capital and what is the competitive intensity in that landscape. So the stocks that you spoke about, they are great businesses. Do we own them, or are we considering owning them today? The answer is no. Right. We still think that there is not much margin of safety at the valuations at which these businesses are being offered. Now, it doesn't mean that another fund manager believes that these are cheap, because he might think that the growth rate is not 20 but 30. Now, whether the 30 is achievable or not is up to their discretion. In our mind, for an Asian Paints, which has given you a cash flow growth of 14% in the last decade, but has given you a share price IRR of 23%. I'm just questioning, where did that extra 8% IRR come from? It came from PE rating. So do I want to basically pay up to own that kind of a business? Though it's a fabulous business, my answer is no. Someone else's answer can be yes.